Financial markets are not a single continuous machine. They operate on a non-stationary distribution, constantly shifting and shattering into chaotic fragments. Because of this, a trading strategy optimized for a steady bull market will mathematically fail the moment the underlying distribution shifts during a crash. These sudden shifts in market behavior are governed by latent regimes, hidden underlying states that dictate price action from behind the scenes. Surviving these markets requires a way to detect these hidden regimes before they destroy a portfolio, rather than reacting to the damage after it's already been done. Most risk management relies on lagging heuristics, such as 200-day moving averages and pairwise correlation matrices. This pairwise correlation heat map of S&P sectors shows exactly why that's dangerous. In a normal environment, the mix of cool and warm colors indicates healthy diversification. But during the structural crash of March 2020, the grid violently snaps to a solid, uniform state. Every sector begins moving in lockstep. This confirms pairwise correlation is a lagging indicator, signaling a crisis only after capital is gone. Detecting this collapse earlier requires a model that treats the entire market as a single geometric object, tracks the speed of its deformation in real time, and applies a probabilistic lens to the result. This necessitates a hybrid approach, using geometric volume and phase space velocity as inputs for a hidden Markov model. This architecture is designed to replace lagging statistical shortcuts with a leading probabilistic framework rooted in the geometry of the data itself. The first step in this model is calculating the Graham matrix. We do this by taking the inner products of our sector returns. To see the advantage, we have to stop viewing price returns as 1D time series. Instead, we treat them as factors in a multidimensional space. Through a Cholesky decomposition of our Graham matrix, these three return series project outward to form a three-dimensional volume, defined mathematically as the square root of the matrices determinant. A large volume indicates that your assets are truly uncorrelated, filling up the space independently. But as market stress increases, these vectors collapse onto a single 2D plane. The enclosed 3D volume shrinks exactly to zero. This volumetric collapse is the geometric signature of a systemic crash. It tells us the shape of the market has changed before prices have bottomed. By tracking this volume, we isolate structural correlation and strip away the noise of individual asset volatility that often blinds standard risk metrics. Step 2 adds a second layer of defense, extracting phase space velocity to measure how fast these systemic shifts are occurring. This chart tracks a market's overall trajectory, S, within its phase space. Panels A and B show the observed trajectory curving upward. Looking at panel C, we see the velocity spiking aggressively at the exact moment of the shift point at t = 50. Taking the derivative of this trajectory provides an instant parameter-free signal that a structural break is happening across multiple variables simultaneously. Standard moving average crossovers require a long look-back window to confirm a trend, which builds an inherent delay into the system. Phase space velocity provides the detection speed needed for algorithmic risk overlays to move at the same pace as the market. For the third step, we need a way to process these inputs. Simple clustering algorithms like k-means are memoryless. They don't care about the sequence of events, which makes them unreliable for time series data. Instead, we use the hidden Markov model as our primary probabilistic engine for regime inference. An HMM assumes the market is always in hidden states, like calm or stressed, that we cannot see. The model infers these hidden states based on the noisy data we observe. We feed our geometric features, volume collapse, and phase space velocity directly into these states. This data feed forms our emission probabilities. While emission probabilities determine which data patterns belong to which regime, a transition matrix dictates how sticky your regime is, or how likely it is to switch on the next step. We train this architecture using the Baum-Welch algorithm, a form of expectation maximization. This allows the model to learn the mathematical footprints of a crash from historical data, without a human ever having to hard code specific if-then rules. The resulting HMM translates raw geometric decompressions into a continuously updating probability of a market regime shift. When moving this from research to live trading, we have to account for lookahead bias, the most frequent cause of backtest failure. Many researchers use smoothed probabilities, which estimate a state at time t by looking at the entire dataset, including the future. Using smooth data in a backtest makes for beautiful charts, but it's mathematically invalid because it relies on information you wouldn't have had at the time. For live signals, we use filtered probabilities. They only look at data up to time t, ensuring no future information leaks into our decision-making. Production-grade models rely solely on these filtered outputs to trigger risk management actions. This distinction separates academic curiosities from algorithms that can actually survive a live trading environment. With the architecture complete, we can measure its out-of-sample robustness against classical risk baselines. These sensitivity analysis grids show geometric features maintain a high Cohen's d, a measure of regime separation, across various rolling windows and dimensions. Empirically, this framework reduces out-of-sample false alarms by 67% compared to standard classifiers like random forests. Applied as a risk controller, this dual-pane chart shows a trend-following strategy beginning a steep dive. As the HMM's filtered probability of turbulence spikes, the system automatically intervenes. Crossing the threshold, the algorithm scales down leverage and tightens risk caps. Implementing this type of geometric risk overlay has been shown to cut maximum portfolio drawdown by 51% without degrading the overall Sharpe ratio. Quantitative dominance relies on this kind of rigorous decoding of the latent geometry hidden within market noise.